Hello and good morning, folks. This is Shikhar Garg along with our very own Mr. Cool Jayaram Krishnamurthy for the Almus Market Mornings. And folks, before we enter into the festive times updates and we go on to discuss the financial markets, I'd like to wish you all a very happy Diwali in advance. And we wish that this Diwali turns out just as explosive and cheerful as Glenn Maxwell Jennings was this week. Coming back, we had the Fed chair's testimony yesterday, where he tried establishing again that they are still careful and okay with the further tightening if it's required. The other section, on the contrary, is the fact that there's a rising number of insolvencies which is being observed. So there's a good tight rope for the central banks to work on, having low inflation and low growth on one side, while even lower inflation and no growth on the other side. That's quite a tricky pick. But other than that, there's a lot of things going on with the sugar squeeze, Bitcoin rallying, Portugal PM resigning, and some ransomware attack on the world's largest bank. Now, there's a lot of things going on globally, but Indian market seems to have already entered into a festive mood. So, JK, what's your take? What should we be looking at?
Yeah, good morning, Shikhar. I mean, nothing much to talk on the Indian rupee. I think market is already in a relaxed mode. I don't think festival holidays make any difference to the rupee traders, actually. Yes, but there is one section of the Indian market which is moving, that is the forward premium. The 1-year implied yield fell to 1.54%. It's the lowest since early July. And almost the near forwards were at the lowest in more than a decade. So what it means normally, forwards falling this way indicates that there is a shortage of dollar liquidity and usually impacts the spot rate as well. But this time around, with RBI supplying dollars to the demand that is in the market, is ensuring that this demand does not really translate itself into a big fall in the INR. That's so much for the rupee, which is actually quite delinked from what's going on in the global markets. Speaking of global markets itself, I think this week has been somewhat light on economic data, and yesterday was no different, barring the jobless claims data, which came slightly lower. But the negative part for the economy was that the recurring applications, are what you call as the continued claims, rose for the 7th straight week, adding to the evidence that labor market is cooling. So continued claim means that once you have claimed, if you continue for the coming weeks also to claim, that means you are not able to find a fresh job after having gone out of the job. So that indicates that jobs are difficult to find, and there is less jobs on offer and more demand for jobs. So that's a real sign of cooling. But that did not stop Powell from making his somewhat hawkish remarks, I would say. He was saying that we are not confident that we have achieved a stance which ensures 2% inflation, and its ongoing progress to a 2% goal is not assured. And in fact, he says also that inflation has given a few head fakes, meaning that a few data points are not sufficient for him to take a stance that the rates have peaked, and we will continue to move carefully, allowing us to address both the risks, both sides of being misled by a few good months of data, and also the risk of over-tightening. So he's very cautious. But yes, I think this was par for the course, because market had gone overboard, selling dollars, buying bonds after the last week's data on unemployment coming a week, and also the Treasury announcement that they will be going for a much lesser long-term bond issuances. So that's got slightly corrected, but definitely much less than the fall that we had seen. So other than that, we did not have much of a data as far as the US market or even the European markets are concerned. The bond yields rose almost 10 basis points for the 2-year, 14 basis points for the 10-year, as well as 16 basis points for the 30-year. Quite a retracement, but well below the rates that we had seen a week back. Fed funds futures are now pricing in 25% chance of an additional hike in January, up from 19% on Thursday morning, but still below what we had seen a week ago. Stocks which had an amazing run of 9 days of continuous gains had reason to correct as the yields went up. And with most companies' earnings report in already, markets now await the US inflation figures. And today we also have the Michigan consumer sentiment and inflation expectation data, preliminary look that will give some early cues. Also, while on the retracement in the bond yields, I should mention that we had a 30-year bond issuances by the Treasury yesterday, which actually yielded much more than what the market was expecting. So means the demand was not so good. So the issuance was somewhat of, I would say, performed badly, 4.76% versus 4.71 that was being expected. So those were the reasons why the markets actually corrected to the downside on the bond prices and upside to the yields, and also stocks correcting themselves, which was quite okay because we had a big run in the stocks. Now currencies fell after the yields rose, but they haven't made a new high, though yen has gone quite near to the sensitive intervention level of 151.70. There's some points which are probably should give some concern going forward. One is the Fed's reverse repo facility, amount of money that investors are parking at a major Fed facility has dropped below 1 trillion for the first time in 2 years. And that means such a confirmation that liquidity is draining out of the system. At the same time, probably, UK will have some sigh of relief because the rental demand there has fallen, and UK officials have been saying that, you will see further sharp falls in the UK inflation. So we are getting a mixed picture, tightening liquidity, then inflation perhaps easing in, fits and starts, and probably US economy's inflation number next week will be a big number to watch out for. And if it moderates further, then you may well see another rally in the bonds, but the market doesn't want to assume that. But the other good news is that the big fall in the oil price, which is now gone below 80 yesterday, but a slight retracement. But with US lifting many of the sanctions against Venezuela and a lot of supplies being forthcoming from there, I think oil prices have a tough time to retrace to the recent levels that we had seen. So not much in terms of numbers again today, except the UK GDP, industrial production, and the trade numbers. And next week is promising to be much more. On Indian side, we will have the industrial production data, which anyway is a very volatile number, not giving so much of a direction to the markets. So we sign off for the Diwali weekend now. Happy Dhanteras for today, and happy Diwali and happy New Year to all of you. Thank you.
Wonderful, JK, and it's quite interesting. I mean, I really like this bit wherein the forward premiums have gone further lower, and probably it is because of the shortage of US liquidity, US dollar liquidity, and we are also having the same set of data points being revealed by the decline in the reverse repo amount, well below the 1 trillion figure mark, which was last seen increasing since 2021. This is quite interesting, but at the same time, as JK mentioned, folks, there is a continuous jobless claim, which is indicating the cooling of job markets. And the job numbers shall be, or the unemployment shall be, the final domino of the tightening cycle. And that's what something we should keep watching out for, as the Fed chair has already mentioned that they're still cautious, and they're keenly watching out on multiple data points. The yields on this commentary have retraced higher, and the equities have caught the much expected pause after the otherwise 9-day upside streak. Yen back at its critical intervention levels have been quite an interesting thing to observe, as the Japanese central bank also is quite active these days. A sharp fall in oil prices and the lifting of sanctions by the US towards Venezuela and other such nations have also been taken by the markets. Well, the oil has had a sharp fall well below 80 levels. These are the global updates, folks. Indian markets, as JK mentioned, have not really had much of an impact even with the festivities. So we enter the festivals with some interesting times to be seen ahead. That's it for today, folks, and we wish you a very happy Diwali as we did earlier. And we hope that you have some good, really good celebratory times with your loved ones. Thank you so much for listening, and we shall come back again on Monday with another round of updates.